Stop what you're doing right now. If you own or even just thinking about buying bank stocks, you need to see this deep 5-model fundamental valuation breakdown of First BanCorp, ticker symbol FBP. Because look, while the mainstream financial media is practically screaming that regional banks are a ticking time bomb just waiting to blow up, this Puerto Rican banking powerhouse is quietly printing money. We're talking about a stock whose intrinsic value might be drastically misunderstood by the market right now.
So last week, I ran FBB through 5 rigorous valuation models and 2 legendary investing checklists. And honestly, what I found totally shocked me. It forces us to ask, are unrealized losses the ultimate value trap, or are they the perfect contrarian buy? That's the bold question we're answering today. Because the surface numbers look absolutely incredible, sure, but there's a massive hidden anchor weighing down their balance sheet.
And hey, I know exactly where a lot of you are at right now. Retail investors are absolutely terrified of getting caught holding the bag on another bank collapse. It's a completely valid fear. But First BanCorp isn't some leaky lifeboat taking on water. It's an absolute financial fortress, sitting on a massive, sector-leading 16.9% Tier 1 capital ratio. They have the kind of excess capacity that most mainland regional banks can literally only dream of.
I mean, they recently hiked their dividend by over 11% and returned a staggering 92% of their Q1 earnings straight back to shareholders. Which brings up a pretty vital question. What would legendary investors like Warren Buffett or Peter Lynch think about a bank growing its net interest income by over 23%, all while sitting on $193 million in unrealized losses? Well, in this explainer, I promise to give you a clear, actionable framework that you can literally steal to evaluate this exact scenario. And I guarantee that by the end of this deep dive, you'll know exactly if First BanCorp is a deeply discounted Buffett buy or a ticking Lynch value trap. So grab your notes and let's get into it.
Section 1. Unpacking the Q1 earnings data, the good and the bad.
Okay, looking at the hard numbers. FBP delivered a really solid EPS beat, coming in at 57 cents per share against analyst estimates of 52 cents. And this was heavily driven by an all-time high pre-tax, pre-provision income of $131 million. Now, yeah, they did slightly miss the top-line revenue estimates, bringing in $258.6 million compared to the $263.5 million expected. But honestly, it's the underlying profitability engine here that's truly compelling.
What's incredibly interesting is this massive 23.42% year-over-year growth in net interest income, bringing it up to $102.5 million for the quarter. This proves they are successfully navigating the higher interest rate environment. Basically, they're earning significantly more on their loan originations and securities than they are paying out to keep their core deposits. It's just the fundamental banking model operating at maximum efficiency.
Section 2. The balance sheet stress test to uncover the hidden risks.
This perfectly captures the dichotomy of First BanCorp. On one hand, we've got incredibly strong liquidity with a low loan-to-deposit ratio of just 76.3% and elite profitability with a 1.89% return on assets. But then, there's the other side. These amazing metrics are juxtaposed against a pretty bloated efficiency ratio hovering near 67% and a massive $193.4 million unrealized loss hanging over their equity like a dark cloud.
Let's unpack that first risk. A 67% efficiency ratio is a major warning sign. Industry benchmarks really want to see this metric under 60%. This high number is largely driven by management raising their quarterly expense base to somewhere around $128 to $130 million. Why? Primarily to fund new technology, AI integrations, and branch network initiatives. You know, it costs money to make money, but that overhead is absolutely eating into their bottom line.
However, they do mitigate some of that macro risk with a 1.44% allowance for credit losses against their loan portfolio. That totals a hefty $121 million sitting right there in reserve. So if consumer defaults tick up, maybe from seasonal auto loan softness or broader economic stress, they are well prepared and over-reserved compared to the industry average of around 1.25%.
Section 3. The Master Checklists, Warren Buffett versus Peter Lynch. So Warren Buffett looks for financial fortresses. His checklist demands high capital adequacy, elite profitability metrics like a return on assets consistently over 1.5%, and a proven, consistent track record of rewarding shareholders. He basically wants safe, compounding machines.
Let's score First BanCorp step by step here. Step 1. Their capital is the strongest in the sector with that massive 16.9% CET1 ratio. Step 2. Their 1.89% return on assets easily clears the Buffett hurdle, and they've done that for the 17th consecutive quarter. And Step 3. A 92% payout ratio makes them an absolute cash-generating machine. For Buffett, this is a resounding pass.
Peter Lynch, on the other hand, focuses heavily on valuation multiples and avoiding obvious, hidden balance sheet traps. He looks for banks that seem cheap on paper but are actually ticking time bombs underneath. He wants a favorable PE ratio, usually under 15, and he rigorously checks the underlying assets.
So, running through the Lynch test, FBP easily passes the first 2 steps. Their PE ratio sits at a super cheap 11.20, which is well under 15, and they're trading slightly below their historical 11.5 times average. But then we get to step 3. This triggers a massive red flag. Those $193.4 million in unrealized losses are highly sensitive to interest rates. Meaning, if rates stay higher for longer, this is exactly the kind of capital-eroding trap Peter Lynch warns retail investors to run away from.
Section 4. The final verdict and conflicting signals.
Based on the models, it's a true split decision. We have the Buffett view. FBP is a deeply undervalued financial fortress, dominating its market and printing 23% higher net interest income. But right against that is the Lynch view. FBP is a potential value trap weighed down by severe rate sensitivity on its bond portfolio and high operational overhead costs eating into revenue. Ultimately, independent analysts give it a $24.58 consensus price target, which is almost exactly where the stock trades today. What that means is, the real bet you're making here isn't just on the numbers. The real bet you are making is on the resilience of the region itself. Which leads me to our final provocative thought. I'll leave you with this. Is there absolute dominance in Puerto Rico, a legendary economic moat, or is putting all their eggs in one island's basket the ultimate catastrophic risk just waiting to happen? Let me know what you think.